balance of payments is essentially an accounting of all the transactions that one country makes with all the other countries. The balance of payments is what we're going to talk about today. That's because both governments and companies use the balance of payments in their decision making. After all, if the balance of payments reflects all the transactions going in and out of a country, it follows that it reflects economic and financial activities of that country. Moreover, looking at the balance of payments and changes in the balance of payments can give you a sense of key macroeconomic rates that might change in the future for that country. You can use, in other words, the balance of payments to understand where exchange rates and interest rates might go in the future. That in itself has an impact. As exchange rates change, so does the competitiveness of one country versus another. As exchange rate changes, so might a country's decision to institute new economic policies, including the possibility of a capital restriction, capital controls. In reality, no matter how isolated a country is, it still has transactions with other countries. The measurement of all these economic transactions is what defines the balance of payments. Balance of payments data is useful whether you're a company or you're a government because transaction data tends to persist. If there's a lot of purchases of a country's goods, for example, continued demand for those countries' goods will likely continue to persist in the future as well. Continued demand for that country's goods means that there's going to be a continued demand for that country's currency. As to purchase goods in that country, you have to have the currency of that country. The more a country sells goods to other countries, therefore, the more demand for that country's currency. The more demand for that country's currency, the higher the likelihood of an increase in the value of that currency versus other countries. But that works both ways. If a country continues to experience a lack of demand for its goods, a lack of exports, for example, that can indicate a decline and a decline in the future of the value of that currency. Not all countries do this, but some countries in such a scenario, particularly certain emerging market countries, may attempt to arrest a decline in the value of their currency. To prevent this from happening further, by instituting capital controls, by stopping the outflow of currency, preventing investors from withdrawing their money from that country, for example. And therefore, the balance of payments can be useful because if you see this situation in a particular country, declining exports, and that country has a history of imposing capital controls, this may be a indication that you should delay investing in this country, or if you're already invested, pull your money out before capital controls become present. Whether for positive or negative, in sum, looking at the balance of payments is ultimately like looking at a dashboard. It's a forecast. It's a indicator of health, both present and future, of a country's economic vitality. The more you can read that dashboard, the better you can understand investment opportunities in that country. So let's dive into the detail. The balance of payments statement looks at a statement of cash flows over an interval of time. Often it's over a year, for example. And with a balance of payments, you've got credit and debit. A credit is an event or a transaction that gets recorded that records foreign exchange inflow into the country. Think of a credit as being like an export of a good or service. Meanwhile, a debit is like money spent, an import. One key feature of the balance of payments is that it balances to zero. What that means in practice, let's take a look at an example of the US. Here, we have the balance of payment split into various sub-accounts. We'll talk about what each of these sub-accounts means in just a moment. But you can see that the sub-accounts each year all sum to zero. It's analogous to a balance sheet, where you have on one side assets, which describes and lists what is owned, and on the other side you have liabilities and shareholders' equity, which really just breaks down who owns it. Now, these sub-accounts here, let's look more into that. There are three major sub-accounts: the current account, the capital account, and the financial account. Now, there is another account called the official reserves account, and that tracks inflows of money in and out of the country on behalf of the government or the central bank. As well, there is this final account that essentially makes the balance of payments balance. It's an errors and omissions account. The current account first. This would be the account that you see most referenced in financial media. That's because the current account measures all the goods trade, imports and exports of physical goods, as well as the services trade. This category of goods and services, this specific category of the current account, that's called the balance of trade. Think of this as all the physical goods that get exported and imported between a country. Let's take a look at the balance of trade for the US. What you see here over time from 1985 to about 2013 is a decline in the balance of trade for the US. That's this series of gray plots here. Essentially, it's the country's exports minus the imports for that year. And because this number is significantly negative, the answer, or the interpretation of this graph here, is that the US imports significantly more physical goods than it exports to other countries. However, the same cannot be said when it comes to looking at the exports and imports of services between the United States and other countries. That, depicted in this blue plot here, shows a surplus in the services subcategory of the current account. Because this is positive here, what this means is that the US actually exports more services than it imports. Services is a broad category. It can be anything from tour packages sold to non-US residents to financial services sold to international investors. The US has a positive surplus when it comes to services, but a deficit when it comes to physical goods. A lot of trade is still of the physical good variety, whether it's the US or any other country. But there's also trade in financial assets. That's what the capital and financial accounts measure. They measure all international economic transactions of financial assets. Of these two, the capital account is relatively minor. It mainly measures the financial transfer associated with selling investments in one country. Investments that are physical, like factories. More importantly is this financial account. This financial account can be subdivided into 4 different components: direct investment, portfolio investment, net financial derivatives, and other. Of these 4, the most important are going to be these 2, direct investment and portfolio investment. These are all financial assets, but as to whether one particular transaction is categorized as direct investment or portfolio investment, that depends on the length of the life of the asset, its maturity, and the nature of ownership. The primary way to categorize whether something's a direct investment or portfolio investment, though, is the degree of control. This relates to how much control you have over that financial asset. Direct investment means lots of control. Specifically, if it's in equity and you have more than 10% of the value of that entire company that you're buying in the form of that equity, that's considered direct investment because you have some substantial influence in what the company is going to do. Conversely, if you have something like a bond, as a bondholder, you don't have a lot of control over what the company does. You don't get to vote, for example, on who the board members of the company are going to be. And that lack of control means that bondholders, those who buy bonds in another country, that inflow of capital to buy those bonds is categorized as portfolio investment because there's no legal control associated with that capital investment. So, direct investment relates to financial assets where there's a degree of control involved. When some investor, let's say in the United States, takes their dollars, converts them into another currency so that they can buy financial assets in that country, that's a financial investment. That's an inflow into this financial account for that country that's receiving the investment. If this investment is, say, 100% of all the equity in a particular company, that inflow is going to be characterized as direct investment because there's lots of control that's going on. The investor can influence what that company is going to do. Sometimes, regardless of what country we're looking at, that influence can trigger political sensitivities. So sometimes direct investment into a country can be controversial. But portfolio investment often isn't that controversial. That's because, as mentioned, there's not a specific level of control associated with portfolio investment. If it's an equity investment that is only less than 10% of all the equity that's outstanding for that particular company, then these investors with less than a 10% stake don't have a lot of control in the direction of that company, and it's categorized, therefore, as portfolio investment. If it's a bond investment, it's also characterized as portfolio investment, because by definition, debt securities do not provide the buyer with ownership or control. Essentially, portfolio investors are really just motivated by finding the highest return in one country versus another. A U.S. investor, for example, might be looking at the U.S. equity market and may instead decide that Brazil, the Brazilian equity market, presents a better investment opportunity. So they will sell their USD and exchange them for Brazilian real, and then they'll take the Brazilian real, the currency of Brazil, and buy up a bunch of Brazilian shares. That transaction is characterized as portfolio investment. Again, assuming they don't reach that 10% threshold of ownership. Now, the portfolio investment category is considered less controversial. However, it does have much more volatile behavior than direct investment, and that in itself can lead to controversies. Take, for example, portfolio investment into and out of the United States. Here, we see a lot of money coming into the United States in terms of portfolio investment. That's foreign investors basically putting their money in the United States to buy treasuries, corporate bonds, equities. Looks like there's a lot of preference for these types of securities from foreign investors over about 2 decades. When the financial crisis hit, though, outside investors basically completely stopped putting in money into the United States, although that rebounded the next year. Portfolio investment, in other words, is volatile. And the problem with this volatility is that it can lead to volatility for the currency itself. Here, we see a lot of foreign investors buying dollars, because in order to buy all these treasuries, bonds, and shares, they have to have USD in order to make that purchase. And so what you're seeing with all this portfolio investment is an appreciation of the US dollar. More demand for the US dollar increases its value, increases the price that investors are willing to pay in terms of paying foreign currency for a certain amount of US dollars. But when all of a sudden that demand shifts, such that investors no longer demand dollars so that they can buy those financial assets, then you can see a very quick, very precipitous decline in the value of that currency. And so some countries are less favorable to portfolio investment because to them, it presents a risk to their currency. That's that over time, their currency can become stronger and stronger. But then suddenly, if there's some sort of shock that causes investors to decide that they no longer want to keep their money in this country, they will suddenly and quickly pull all of their money out because it's very quick and easy to sell shares. It's difficult to sell things like factory or a big ownership stake in a company. But portfolio investment, it's very easy to pull that money out. And investors, if they turn fickle and they decide that they don't like investing in this country anymore, they can very quickly pull their money out. And that can have very quick implications for the value of that country's currency. For a country who decides that exchange rate stability is in its best interest, portfolio investment is therefore pretty risky. But of course, it has benefits as well. Having investors financing businesses in the country promotes economic growth. And so it's a trade-off. Now, we mentioned these last two categories, net errors and emissions account and official reserves account. The net errors and emissions account is there because you have all these different categories, and when you sum them up, they should equal to zero. But the way data collection works for all of these balance of payments is that some government agency will get information from banks, ports, other places, and tally all that information up. If there's some participant, some economic participant, say an exporter, that doesn't actually report their export sales, perhaps because they want to avoid taxes or some export control, then that will show up, or that won't show up, as in the balance of payments account. So these errors will accumulate, and they'll accumulate in the net errors and emissions account. Official reserves account is a more important account, particularly for countries that manage their exchange rate. For countries that don't manage their exchange rate, this account is pretty negligible. It's not a very big category. But for countries that do, this can be quite sizable. The official reserves account consists of typically major currencies of the country's trading partners. If a country manages its exchange rate, and it does a lot of business with the United States, for example, they'll probably have a lot of US dollars in their official reserves account. And again, the size of this account depends basically on whether they operate a fixed exchange rate system or something similar to it, like a pegged exchange rate system or floating peg, versus a floating exchange rate system. Let's take a look at why that is the case. Suppose you were a country that wanted to manage its exchange rate against the US dollar. You see these two black lines above and below. Your country doesn't want the exchange rate to go above or below this pre-specified value. Let's say we're looking at the perspective of China that wants to manage its upper and lower exchange rate value. It doesn't want the yuan to become weaker than 7 RMB to the US dollar, but it also doesn't want the yuan to become stronger than 5 RMB to the US dollar. So anything above here, it needs to act. Anything below here, it also needs to act. And remember, this upper category is where the yuan is weaker. That's because $1 buys more yuan. And this lower category is where the yuan is stronger. That's because $1 buys fewer yuan. So if the Central Bank of China, the PBOC, wants to make sure that the yuan doesn't get too strong, there's a relatively easy solution to make sure that the yuan doesn't reach this category here, this threshold. Because all they need to do to decrease the value of the yuan is to create more of it. They can just print more CNY, more Chinese yuan, and then sell it in the foreign exchange market. That act of doing so, the act of printing all this money and then selling it out in the open market, will, just by increasing the supply, lower the value of the yuan against foreign currencies. It's just supply and demand. The more you increase the supply of something, if demand stays constant, the lower the price for that good. In this case, the currency of China. So the central bank, because they can control the supply of the currency, can pretty easily prevent the value of the yuan from getting too high, from getting too strong. They can always just print more yuan and sell it. Of course, there is the side effect of inflation. If you're creating a bunch more money in the economy, potentially you're going to increase the prices of goods. But it is still possible, pretty easily possible, to at least effectively prevent the yuan from getting too strong, albeit with this side effect. But what are they going to do when the yuan is too weak? In other words, what do they do in a situation like this? How do they make the yuan stronger? The problem is that they can't just create other countries' currencies and sell those countries' currencies in exchange for the yuan. That would certainly boost the value of the yuan, but they can't create other countries' currencies. Those countries would have a problem with that. Instead, to prevent the yuan from becoming weak at this level, what the Central Bank of China will have to do is to prepare in advance. They'll have to hold reserves, build up a pile of reserves. These reserves are not denominated in Chinese yuan. They're denominated in other countries' currencies. Think of them as like the central bank will accumulate US treasuries or various European government bonds denominated in euros, or Japanese government bonds, JGBs. Now that they've built up a pile of foreign currency, what they can do when the yuan becomes weak like this is to take some of this pile of dollars that they've built up, for example, and sell it. They will sell US dollars that they own, and in exchange, they'll buy up more of the Chinese yuan that is out in circulation. If they do this in a big enough quantity, the value of the dollar will fall, and the value of the yuan, the currency they're buying, will rise. They will bring this back, in other words, to a region where the yuan is stronger. So that's why central banks of countries that manage their exchange rate have to have a bunch of foreign exchange reserves. In the case of China, which manages its currency versus that of the US dollar, actual reserves are about $5 trillion. They're not all dollars. About 3 trillion are in US dollars. The remaining trillions are based in other major currencies. But the Central Bank of China has a huge reserves account. And they have it because they want to maintain the value of the yuan within a certain range.